This episode is brought to you by LifeLock. October is Cybersecurity Awareness Month, so LifeLock wants to remind you to update your passwords. Using the same password across multiple accounts makes you vulnerable to cybercriminals. For comprehensive identity theft protection, let LifeLock alert you to anything suspicious and fix any issues. Start protecting your identity today with a 30-day free trial at LifeLock.com/podcast. Terms apply.
It's the Larry Kudlow Show. Free market prosperity starts here. Now, here's Larry Kudlow.
Good afternoon, folks. This is not Larry Kudlow. This is Steve Moore. You are getting sort of 3 hours, an extra hour of the More Money Show. Larry is under the weather today, and so, boy, are these big shoes to fill, but an honor to be doing the last hour of the Larry Kudlow Show. And then, of course, we'll be on for the normal 2 hours of the More Money Show. So we'll be on for 3 hours, and we are live. We are in color, and appreciate you all joining the show. By the way, in the second hour and the third hour, I will be taking your questions. I want to talk a little bit at some point, and I want your all reaction to how the dock strike was handled and whether you like this outcome. I don't know. I don't know if I like it or not. I mean, I'm glad to see that these workers are back on the job, but I'm not so sure a 70% pay raise was justified. Maybe it was, maybe it wasn't. My buddy Larry Kudlow and I argued this out in a friendly way, of course, on his show the other day. I think that the Biden administration, put its thumb on the scale in favor of the unions and forced the folks who own these docks to capitulate to them. And this is a big increase. And look, maybe I'm wrong. And I agree, by the way, with Larry Kudlow, and I totally agree with Donald Trump. And Trump has basically said throughout this whole melee that the reason you were seeing so many strikes around the country and so many threats of strike, and this has been the case for the last few years, is because union workers have been crushed and steamrollered by this high inflation. Prices are 20 to 25% higher. A lot of unions agreed to union contracts locked in at maybe a forecast of 3 or 4% inflation when in fact we had inflation twice as high. So I get that. And I understand why the union workers, just like all workers, are angry, and they should be. They should be. Look, when you spend and borrow $5 to $6 trillion above the normal amount that we borrow, which is too much already, and you print the money to finance it, you're going to get higher inflation. And I want to make one other quick point before I bring on our first two guests of the afternoon. And that is that I think inflation is back. And I'm going to ask our two guests about that. But I've been following the what is called the commodity index. And ever since the Fed lowered rates with what the Wall Street Journal called their jumbo rate cut, the commodity prices have been soaring. The commodity prices are now up almost 11%. And that's corn and copper and wheat and steel and gold and silver. And when those prices go up, I'm here to tell you, I think we are going to see a resumption of inflation. Just look at something called the CRB index. You can look it up on your computer. And you see, as soon as the Fed cut rates, the inflation just started to shoot up again. And I'm not saying we're going to have 9% inflation like we did in Biden's second year, but I do think we're back on a track 4 or 5, maybe even 6% inflation. Maybe I'm wrong. Maybe this is just a temporary blip. But you look at that index of commodity prices, they're just shooting up like a fountain spurting up. And that makes me very nervous because if prices of commodities go up, steel, aluminum, corn, copper, oil, that means everything else has to go up. And I think you're going to see a spurt of higher inflation, higher consumer inflation. I hope I'm wrong about this, folks. I mean, we're already suffering from very high prices at the grocery store and the gas pump. But I'm here to tell you, as I look at the situation right now, I think you're looking at another spurt of inflation. But why don't we ask two of the experts, two of the wizards of the financial markets, regulars on the Larry Kudlow Show that are joining me this afternoon. And I'm talking about Stephanie Link, who is Chief Investment Strategist at Hightower Advisors and Head of Investment Solutions. And then Ken Polcari, Managing Partner at Kace Capital Advisors, Chief Marketing Strategist at SlateStone Wealth. Stephanie and Ken, thanks for joining this afternoon.
Thanks for having us.
All right. Well, I'm trying to fill big shoes here, as you know. Larry's a little bit under the weather, but I'm so pleased to have both of you. Thanks for joining. And Stephanie, I want both of your thoughts about this, what I just said. But I am worried about inflation. I really am. We've had tame inflation for the last 18 months or so. But as I look at the situation, I'm starting to see those numbers budge up. What say you?
Yeah, I would say that we made enormous progress on inflation. Our peak was at 9%. We got down to about 2.2. And I actually would tend to agree with you that inflation likely has bottomed. I don't know if you're going to see 4, 5, 6%, Steve, but I do think we've seen the bottom. Does it kind of hover around 3%? And it's entirely possible. But here's the thing. The reason is because the growth is better than expected. Everybody asks, and everyone has been asking, can the Fed engineer a soft landing? Guess what? We're in a soft landing. We're growing 2.5% to 3% according to Atlanta Fed Tracker. All the data last week came in a little bit better than expected with initial claims, ISM services, non-farm payrolls, hourly earnings. Even the Redfin CEO, he talked about new home buying last month alone up 10%. So the economy is growing, and the economy is growing above trend. I will take a little bit higher inflation, but higher growth any day, because from an investor point of view, that means good for corporate profits. And our dear friend Larry Kudlow taught me this 18 years ago when I met him. Stocks follow profits, right? On the way up and on the way down. So I think if we do see inflation, it's because the growth is actually more than expected. And oh, by the way, just throw in China stimulus, the bazooka that they threw in 2 weeks ago, that too will probably lead to better growth, again, better inflation. So I'm with you. I don't think it spirals out of control because I think supply chains have largely been fixed. But also I think that the growth is better, and that is the culprit of a little bit higher inflation, which is not bad.
That's Stephanie Link with Hightower Advisors. Great point, Stephanie. So, Ken, I guess it's, I'm a little less bullish than Stephanie is on the economy. So I guess you're going to have to break this tie.
No, so listen, I appreciate Stephanie's view, and I agree for most of what you both said, but I would be more in your camp. I'm afraid that we're going to see this reignite, right? And look, when you have things like the longshoremen getting a 70% raise, those higher wages are going to cause those employers to have to raise their prices to cover those wages. So in the end, who's paying for that? You and me are paying. Ultimately, where the consumer is going to end up paying for that, right? And then you're going to start to see, because you've already seen it already, the different unions that have negotiated so far. They've negotiated decent wage increases, partly because the Biden-Harris administration created such raging inflation that, these men and women got caught, right? And they don't want to get caught again. And so my fear is that we could see inflation tick up if the Fed continues to cut. I don't think they're going to cut anymore, quite honestly. I think the 50 basis point cut was a little bit of a panic cut, but now after Friday's job report, to Stephanie's point, we see the economy growing. The economy is very resilient. There's no reason to stimulate it even more by lowering rates at all, in my opinion. So let's see what happens. But
so
I think
Ken, you're making an excellent point, and that is that. And by the way, I don't know how old you two are, but I'm 64, so I lived through the 70s, and you're starting to see a little bit of a recurrence of what happened in the late 70s in terms of labor unrest, because as I said earlier, unions are angry about, they locked in themselves into, contracts with 3 or 4% raises. And now they're looking at inflation and they would say, wait, we want 7 to 8%. And so you could get a wage push inflation out of this, because I think other unions, Stephanie, are going to kind of look at what the longshoremen got and say, hey, we want our cut too. Right. And if you're looking at, what is it, 70% over 5 or 6 years? I don't remember the particulars, but that's a lot. And so what do you think about that, Stephanie, because that was an enormous raise for these workers. And I worry that the other unions are going to follow suit.
It's entirely possible, but I'm going to take the other side of higher wages. higher wages are good for consumers. Think about that. It may not be great for companies, but if people have jobs, and we know the labor market is probably balanced. It's not super tight like it was a year ago, but it's balanced. There's 1.1 jobs available for one unemployed person. And if you get wage increases, which, by the way, the non-farm payroll number on Friday showed 4% growth year over year. You have jobs, you have wages. You have the unions, maybe, okay, fine. They're getting wage increases. Fine. That is good for the consumer. They will spend. 70% of our economy is the consumer. And, oh, by the way, as I mentioned earlier, ISM services last week was on fire. It was near 60%. That is huge growth. And we know
sorry, what, Stephanie, say that again. What was that again that was up 16%? What was that?
ISM services was up 60%.
Got it. Right.
The survey, right? The survey.
Yeah. Oh, yes.
It was at 60.
But that was, hold on just a second. So that was the services sector of the economy, right? Right.
Yeah.
Okay.
Yes, but we care about services because it's 75% of consumption, right? It's 75% of consumption. You have consumers that have jobs. You have consumers that have wages. So, okay, let's see how the companies can actually deal with it. They will likely raise prices, but if people have money and they have jobs, they will spend. We have seen that, and that is the driver of the growth overall. So it's not all gloom and doom, in my opinion.
So that's Stephanie Link with Hightower Advisors. Ken Polcari is with us as well from Kace Capital Advisors. So, Ken, the reason I disagree slightly with what Stephanie is saying is that, wages, if wages rise faster than productivity, then that is a de facto rise in inflation because wages can't go up faster than inflation without prices going up. And we haven't seen, we have not seen good labor productivity numbers. In fact, they've been pretty lousy under Biden. So that's kind of my concern. How do you fall on this?
Right. So, I'm with you, right? So I'm 63. I was also there in the 70s when we saw this whole thing play out. Stephanie's benefiting because she was younger than we are. So she was probably a baby in middle school when this was happening. But one way or the other, that whole wage price spiral that happened in the 70s, late 80s. And my fear is that we could see that, to your point, we could see that again. Now, yes, the economy appears to be strong now, yet if the economy is as strong as it is, then why are we continuing to talk about the interest rate having to come down to be neutral? In my opinion, it's probably neutral where it is considering the economy is as strong. If they cut rates anymore, they're going to overstimulate, and that's what's going to ignite it. So, I'm in the camp that they should stop. I was never in the 50 basis point camp to begin with. And so, yes, my fear is I'm more with you on this argument because we lived through it, right? In the late 70s, we lived through it.
So here's the issue that worries me for both of you. And maybe, Ken, this time I'll start with you. I'm a fiscal analyst. You guys are financial analysts, but the budget is a disgrace. And I don't know if you saw that on October 1st, obviously, we started a new fiscal year. So we're now in fiscal year 2025. So 2024, we've closed the books on this. Do you guys know what the deficit came in at?
Mm-hmm. No, but I'm afraid to ask.
I know. I had been saying throughout the year that it was going to be $2 trillion, and I was wrong. It's come in at almost $2.3 trillion. That's almost, that's almost $200 billion a month of borrowing. And Ken, that really concerns me.
It's a big concern, and I've been talking about that as well. And I think we've been talking about it, Stephanie and I, with Larry anyway, the last couple of times. But, it's going to cost Janet Yellen is going to have to bring a lot of supply to the market to pay for this. And like anything, more supply is going to equal lower bond price, going to equal higher yields, right? And higher yields then is going to be an option for people, savers and investors to lock in higher yields and take money out of the stock market just because, right, higher yields safe higher yields will cause money to move out. So I'm a little bit concerned that the market might see some headwinds here as a result of that. But yes, it's only going to get worse, by the way. That deficit's not going to get any better as we move along.
Yeah. Stephanie?
Well, I get that question a lot from advisors when I go around the country and their clients. And to be quite honest with you, we are a kick the can nation.
Right.
We are a kick the can nation, and we are not going to address the deficit in the next 4 years. Both presidential candidates are spenders. Trump he will spend differently than Harris, but they are both spenders. So don't think that the deficit is actually going to get addressed anytime soon.
That is true. We're going to take one just quick break. This is Stephen Moore subbing for the great Larry Kudlow. Larry is a little under the weather today. We'll be right back.
This is the Larry Kudlow Show.
This episode is brought to you by LifeLock. October is Cybersecurity Awareness Month, so LifeLock wants to remind you to update your passwords. Using the same password across multiple accounts makes you vulnerable to cybercriminals. For comprehensive identity theft protection, let LifeLock alert you to anything suspicious and fix any issues. Start protecting your identity today with a 30-day free trial at LifeLock.com/podcast. Terms apply.
Now, back to the Larry Kudlow Show.
Welcome back, folks. This is Steve Moore subbing in this Saturday afternoon for the great Larry Kudlow. An honor to be in front of the microphone. I'm on with Stephanie Link of Hightower Advisors and Ken Polcari with managing partner at Kace Capital Advisors. We only have a few minutes left. By the way, Stephanie, I'm sure that Larry would love your optimism. You know, he is one who is the ultimate optimist when it comes to the U.S. economy. So, are we? I guess on the way out, I'll start with you, Stephanie. Are we buying now? Are we selling? How do you see this market? Because it seems like it's we've had a pretty good run.
We've had a great run. We've had a great run this year. We've had a great run last year. Yeah. But the point being is the growth in the economy is better than expected. It's running above trend. Corporations are also seeing 8 to 10% earnings growth. What is very healthy is we're starting to see a broadening out in the market. So it's not just Mag 7. You can own Mag 7 if you like, but I'm trying to buy some of the other stuff. And I would just say quickly, some themes would be housing, power, grid, cybersecurity, financials, animal health. I like all those themes. I think we have volatility in October.
What was the last one you said?
Animal health.
Animal health. Okay.
Yes, I have 4 pets, so I'm a big believer
we have 3. Okay, Ken. Before I want to let Ken get in here because we're running a little short on time. Ken, what's your take?
Yeah, so I agree. I while you might own the Mag 7, I'm not adding to the Mag 7, right? So I'm not chasing that. But I like industrials, financials, consumer staples, especially if you're worried a little bit about the economy hitting a little bit of a rough patch. I think it's always prudent idea to have consumer staples there and value names that are good dividend payers that are going to help weather that storm.
So one quick thing in our last 90 seconds, I have a piece in the Wall Street Journal next week, just basically saying that if we were to raise the corporate tax and the capital gains tax, as Kamala Harris is talking about, that's going to be bad for stocks. Ken, what do you think?
100%. 100%. And if they start taxing unrealized gains, that's going to be even worse, right? Although I don't know what brain surgeon came up with that idea and how it even takes to the agenda. But one way or the other, yes, I do think that the market will come under some pressure if she starts raising taxes at the pace that she wants to talk about. The only thing we can hope for is split Congress.
Stephanie, what's your take on that?
It depends on the rate of where it goes to. If it goes to 28%, corporations will be able to handle it.
Yep. Okay, that's 2 of the best in the business. Ken Polcari and Stephanie, thanks for joining.